Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Baba stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 281 billion market cap. They're trading at $115 a share, and they have 2.5 billion shares outstanding. Baba provides technology and marketing to help merchants, brands, retailers, and other businesses engage with their users and customers. The company operates through 7 segments. The first is China commerce. The second is international commerce. The third is local consumer services. The fourth is Sign Now. The way that's spelled is CAINIAO. The fifth is cloud. I think they're number 4 in cloud computing. Amazon is obviously number 1, AWS, Amazon Web Services. Then Microsoft Azure. Those two are far ahead of the competition. Third is Google Cloud. Fourth is Baba Cloud. Alibaba also operates Taobao, China's biggest consumer-to-consumer retail platform. They also operate Tmall, a business-to-consumer online retailer. That was spun off from Taobao. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Look at the growth from 21 to 22, 85%, and went from 12.5 billion to over 23 billion. Unfortunately, it came down in 2023 to 21 billion. Came down even more in the trailing 12 months, 19 billion. But still, 19 billion of free cash flow is a lot. It's not like their business is shrinking. Their business is growing. They're just investing more into CapEx. That's why their free cash flow is lower. Net income is a profit or loss on the income statement. It's revenue minus expenses. That grows from 21 to 22 to 23, over 11 billion. It came down in the trailing 12 months to 10 billion. Margins are decent for a retailer. 7 to 8%. If this was a brick and mortar retailer, the margins would be 1 to 3%. It's online, so the margins are a little higher. Plus, they do other things, not just e-commerce. Like I mentioned earlier, they do cloud computing. Revenue is a sales for the company, and that grows each year from 119 billion to 133 billion. All these numbers are in US dollars. I remember when I was a kid, there wasn't many companies with over 100 billion market cap. Now there's a lot of companies with over 100 billion of revenue. They do pay a dividend of 1.75%, which cost them $4.9 billion, but they can cover that 4 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows. Past year 4, that's 446 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $359 billion. We divide that by 2.5 billion shares. And we get a calculated stock price of 146. They're trading at 115, so they're trading at a 22% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 44 companies in the same industry as Baba, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, 4.4 billion. But look at Amazon, 55 billion. These big tech companies are spending so much in CapEx, mainly because of AI. I hope that investment pays off. They have a really good debt to equity ratio, 0.2. For every dollar of equity, 20 cents of debt. They pay a nice dividend. Only 4 companies out of the top 20 pay a dividend. I wonder when Amazon's going to pay a dividend. Free cash flow of 19 billion, a little more than Pinduoduo PDD. Second in market cap, 281 billion, really far behind Amazon. They're trading at 2 times book value. Price to book is stock price over book value per share. They're trading at 29 times earnings. That's stock price over earnings per share. They're trading at 15 times free cash flow, stock price over free cash flow per share, and trading at 2 times revenue, stock price over revenue per share. Another way to calculate price of sales, it's market cap, 281 billion, over revenue, 133 billion. That equals 2.1. They generate a ton of revenue. JD generates a little more, actually. Of course, Amazon is number 1. Amazon pretty much generates more revenue than any other company in the world, except Walmart. And Baba is still growing. Their 5-year annual revenue growth rate is 17%. PDD is number 1 at 73%. C is number 2 at 63%. So to summarize, I have them trading at a 22% discount. I give them a ranking of 7 out of 10. Really solid company, great fundamentals. Would I buy them? 6 out of 10. I love the company. It's just a country risk. If this was in another country, the UK, Canada, the US, it would be $1 trillion company. But it's in China, so the price is pushed down. Really good ratio, 7 out of 10. They have a good price to free cash flow and PE. Price to book and price sales are also decent. Financials, 8 out of 10. They still grow year after year. Their free cash flow is plateauing, but that's because they're investing into CapEx. Lots of companies sacrifice profits and cash flow for higher revenue. Let's take a look at their most recent quarterly presentation. This is the second quarter of 2024. Total revenue, $33.5 billion US dollars. To convert from US dollar to Chinese yuan, you multiply by 7. Or to convert from yuan to US dollar, you divide by 7. Adjusted EBITDA, I wonder why they didn't include the D. That's $6.2 billion US dollars. Lots of cash, 55 billion of cash. Net cash. Net means net of debt. They do footnote it. This includes cash and cash equivalents, short-term investments, and other treasury investments, less bank borrowings, unsecured senior notes, and convertible unsecured senior notes. Taobao and Tmall are winning the mind share of our consumers. This past quarter, we achieved high single-digit online GMV. That's gross merchandise value. That's the value of the merchandise they sold. And double-digit order growth. Our cloud revenue, excluding Alibaba consolidated subsidiaries, grew at 6%, driven by double-digit public cloud growth and increasing adoption of AI-related products. You always have to sprinkle in AI, that's what people want to hear. Their international platform is also growing as well, especially AliExpress Choice. During the second quarter of 2024, they repurchased 613 million ordinary shares, or 77 million American depository shares. So they bought back 5.8 billion of their own stock. And the board authorized to buy back 26 billion through March 2027. Here's the repurchase by quarter. This is the previous 8 quarters. This quarter was the biggest, the second quarter of 2024, 5.8 billion. Even bigger than the first quarter, which is 4.8 billion. They're making so much money, they don't know what to do with it, so they have to buy back stock. Their shares outstanding have gone down dramatically from 2.6 billion to 2.4 billion. In the second quarter alone, they bought back 77 million shares, which is more than the second half of 2022. The second half of 2022 was 24 plus 45, 69. Operating income, 36 billion, down 15% from the second quarter of 2024. It was 43 billion. Pre-tax income is 33 billion. It was 36 billion in 2023. These are in Chinese yuan, so you have to divide by 7. So it's roughly 5 billion in 2023, maybe 4.5 billion in 2024. Net income is down 27% from last year, 24 billion last year, 33 billion. Operating cash flow, 4.6 billion just for the second quarter of 2024. That's US dollars. Minus 2.2 billion, most of that is CapEx. Free cash flow, 2.4 billion. They spent 5.9 billion in buybacks. Free cash flow was 2.4 billion. The reason buybacks are so much higher than operating cash flow is because they had a lot of cash on their balance sheet. There are some investors who think a lot of cash is a good thing. You don't want too much cash on your balance sheet because you don't invest in companies to hold cash. You invest in companies to grow the business. Maybe they acquire other companies, maybe they grow organically. But a good investment is also buying back stock, investing in your own company. They have 84 billion of cash on their balance sheet and debt of 30 billion. So they could pay down all the debt and still have 56 billion of cash left over. Here's a look at their operating expenses. Cost of revenue, these are all the expenses directly tied to generating the revenue, like cost of the factories, cost of labor. So the cost of revenue went down as a percent of revenue, which is a good thing. You want it to go down. It's an expense. Cost of revenue was a little under 60%. This excludes stock-based compensation. Product development went up a little bit to 4.8%. These are in Chinese yuan, so 12 billion. 12 billion divided by 7, that's about 1.7 billion US dollars. Then you have sales and marketing. That went up quite a bit from 11.6% to 13.3%. So 13.3% of their revenue was spent on sales and marketing. Then you have G&A, that was about 5%. So expenses went up in every category except cost of revenue. Here's a nice breakdown of their revenue by segment. Their biggest segment by far is Taobao and Tmall. 113 billion of revenue. $49 billion of adjusted EBITDA. The total EBITDA for all segments is $46.3 billion, which is lower than Taobao and Tmall, so they're losing money in the other segments. All the gains are in this section. Cloud is positive, $26 billion of revenue, $2.3 billion of EBITDA. It was the same thing in 2023. Taobao and Tmall was higher than total. So total revenue, $265 billion, up 6% from last year. $113 billion in Taobao and Tmall. International digital is second at $29 billion. All other segments is $47 billion. They have lots of segments. They do business in a lot of different places. They do footnote it down here if you wanted to look at what the other segments are. Let's look at the stock on Simply Wall Street. Its last price, $115, $266 billion market cap. The stock is up 7% in the past week, up 33% in the past year. Here's the stock price since they started trading in 2014. 88 bucks a share. The peak was over 300 at the end of 2020. By the end of 2022, it fell to its lowest point, $63. Actually, I think it did fall below 60 in 2015. I remember lots of people buying the stock, and most of them sold it at a loss because they were waiting and waiting, and it kept going up and down, and they lost faith. But the past few weeks, it's been on a surge. I'm not sure if it's going to continue. I think it definitely should. It's a solid company, and it does belong at these higher levels. It's just they're in China. That's why the stock price is so low. Simply Wall Street's valuation is 173. They say the stock is 34% undervalued. If you want to know how Simply Wall Street values the company, they give you the data. You can hit the data right here, and they show you their free cash flow model. They use a really low discount rate, 7.7%. Discount rate is the WACC, weighted average cost of capital. Their growth rate is 2.5%. I usually use 2.5% as well. The growth rate is usually pretty close to the risk-free rate, or the same in this case. Levered beta, levered means debt. The way the company gets the future free cash flows is from analyst estimates. So 5 analysts projected their levered free cash flow to be $154 billion in 2025. And when you present value that number back to today, it's $143 billion. They do a 10-year model, so they show you 2025 through 2034. The sum of the next 10 years of free cash flow is $1.2 trillion. And then they calculate the terminal value. The same way I calculate it, just the inputs are a little different. My WACC is a little different. We use the same growth rate, so the terminal value is 3.6 trillion. The present value of the terminal value is 1.7 trillion. So the total equity value of the company is 2.8 trillion. Equity per share is 1,200, and then they convert it to US dollars. Multiply by 0.142, 174 a share, which gives them a discount of 34%. 44 analysts priced this stock at 113, pretty much where they're trading at. Here's their free cash flow since 2021. It was 172 billion Chinese yuan. It fell to 90 billion, then it's been growing again, peaked at 179 billion in the third quarter of 2023. This is for the trailing 12 months. And their current free cash flow is 126 billion. 2025 forecast 154 billion. These numbers should match the DCF we just looked at. Then 169 billion, then 181 billion. Here's their actual revenue since 2013. It was only 49 billion yuan, which is a little over 7 billion US dollars. The company is a giant. They just grow year after year. Now it's nearly 1 trillion Chinese yuan. Their debt has been growing as well, from 40 billion up to 200 billion, which sounds like a lot of debt, nearly 30 billion US dollars. But their equity dwarfs their debt. But more importantly, they have more cash than debt, so it's like they're debt-free. Debt is a great tool to grow and scale. Their dividend at the end of 2023 was 1.4%, and it has been coming down because the stock price has been coming up. The forecast is 1% in 2027. 43% of the company is owned by institutions, 42% by the general public, 13% by public companies, 1.5% by individuals. Masayoshi Son's SoftBank is the biggest shareholder at 13%. This is arguably one of the best investments ever. In 2000, SoftBank invested $20 million in Alibaba. That investment turned into $60 billion when they went public in 2014. If you 10x $100, that's a great investment, but it's still only $1,000 at the end of the day. It's hard to grow 20 million at a 10x pace or a 50x pace or a 100x pace, but they did it with this investment. For most of us, $20 million would be like retirement money. That would be the end. So if we turn, say, 100K into 20 million, we'd be on top of the world. But imagine turning 20 million to 60 billion. It would be hard to just spend $60 billion for the rest of your life. 20 million is nothing compared to 60 billion, of course. The investment firm Vanguard is second biggest shareholder at 3.7%. Then BlackRock, Norges Bank, the Norwegian bank, JP Morgan, the largest bank in the world. And they employ a small army, 250,000 people in 2020. It is down to 200,000. And the ticker trades in lots of places: the New York Stock Exchange, Zicha, Deutsche Börse, Mexican Bolsa, the Bern in Switzerland, London Stock Exchange, BATS Europe, Wiener Börse. That's a really big exchange in Vienna, Bulgaria, Buenos Aires, Hong Kong. They also trade in the pink sheets in the US, Deutsche Börse, Mexican Bolsa, the Stock Exchange of Hong Kong. They trade in Thailand and Sao Paulo. So that's the end of the video. Let me know what you think. Give it a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.